Hi, I'm Lewis Johnson of Capital Wealth Advisors. And I'm panicked about deglobalization.
Knuckles.
That is me. Howard, how are you?
We're broke. You didn't know?
No, I'm not broke.
This is the last day with that fancy microphone.
Okay. Oh, you lost all your FTX. I'm sorry, man.
Yeah, let me do not an apology, just like what I've learned. Well, we can make it an apology because I'm an idiot, but I've hopefully contained my idiocy to just myself. We are in one of the most interesting moments in financial history, and my guest today is Lewis Johnson. He's not famous, but he's a really good pal. I've had him on the podcast. He's been so right. And as I said, when I got back from the summer vacation, I'm just having friends on the podcast, people that have seen things that interest me, not famous people for the sake of famous people, Knut. And here's the problem of some of the mistakes that I've made. You know, I've had Lewis on. We talked about, man, I think this trend is ending in tech. And Lewis came on in 2020 and was talking about value and about like the switch that was happening. And he was right. He wasn't like pounding the table what I should do. He was just telling me how he saw the world. Anyways, rates were cut. 2021 was a party. And, you could sense the party. Now, I had Sam, I forget what month we had Sam Bankman-Fried on, Knut, but it was sometime June of 2021. And believe me, when I had him on, he was not famous like he is today, right? I don't think you had heard of him, Knut. Most people had not heard of him.
I had not.
And my excitement over having him on the show was the product and just the growth that as a non-FTX user, I just kept hearing the name FTX, and we had a pretty good conversation. A lot of it over my head, and a lot of it me asking him my silly questions about, boxers and briefs and dating and life in Hong Kong. Little did I know that we had a Bernie Madoff, and I say this because I've been around criminals, unfortunately, in my business or sociopaths, and I am now, I was, part of publicizing a person that has become one of the worst financial criminals of all time, unless we're mistaken and all the news is wrong.
That's possible.
So I have just, it makes me rethink how I talk to people and what this podcast is about, because we had a great conversation, Knut, him and I, about strategy, about AngelList, about stock twits, about how trading worked. A little bit over my pay grade, some of it, but we had he understood things. So much so that he ended up investing $20 million through stock twits. So, we are connected in that way. Mm-hmm. And I became very good friends with Sina, who ran their growth, who is now out, publicly just as confused as the rest of people. I know Sina well. He was responsible for doing the deals with Tom Brady and athletes. And I feel like in some way he was looking out for me in hindsight, because I shared so many ideas with them for what to do from a strategic standpoint. And some of the things they did, very smartly. But here we are, November 2022, and at least a $10 billion fraud has been perpetrated in the crypto space. So I feel sick that I had this person on and couldn't pick up on the signals. Obviously, a lot of money poured into his coffers over the last year and a half since I had him on the podcast, and it's a shame. And so, I feel for people because I've been there. I've had fraud happen to me. I've written about it. I've shared it on the blog recently. It is hard to pick up. I will say that, as much as, I did my part in promoting Sam as someone who's intelligent and smart and an innovator in the space, So we did our part here at the podcast by having him on. Boy, did he get some people. And he got some of the people that are supposed to be watching out for us, and I take some responsibility there too. So I hope for people that, I know tons of people emailing me, they have $1,000, $10,000, $100,000, $1 million at FTX is bad. I definitely did not, you know me, I'm not into crypto as like storing it myself or trading it. I haven't represented. We don't do ads here. So, you know, there's a lot of lessons here. And our guest today, Lewis Johnson, will talk about this. We'll talk about deglobalization, which has been Lewis's theme for the last 2 years, and he's been dead right, because this show is still about how do we position ourselves. And so I look at Lewis as a friend who kind of is my psychologist and someone that if I were to give money to, he has a vision of how the world looks in a deglobalized way. And so we want to walk through that and just talk about life. He lives in Naples. You can go listen. We'll link to his old podcast here. And when you listen to him, you'll realize he's a person worth following because he's a steady hand and understands diversification and how cycles work. So I also want to talk about 5%. You know, we want to talk about the macro, 5% interest rates, and let's dial up Lewis.
Sounds good.
Lewis.
Hey, Howard, how are you?
Thanks for joining me. Have you been defrauded ever? I mean, this is the closest I've been. I've definitely lost money. I'm an investor in Multicoin who are suffering. So indirectly, I'm taking some hits, personally, financially, related to FTX. Have you ever been around fraud? Like, have you seen it in your life?
I don't think I've ever been personally caught up in that, Howard. But like you, I've been in the market a lot. And when I saw the whole FTX thing went down, the first thing that I thought of was kind of like a Bernie Madoff moment. Mm-hmm. Like you may recall, that was December 2008. Market had been going down for a year. People were pretty freaked out. And then you had this guy that was part of the establishment that all of a sudden admitted that, I don't know, 10 or 12 years it had all been fraud and it was a massive Ponzi scheme. And, and so it was there was a lot of emotion that was charged into that moment, so like you, I'm not really active in crypto, but I'm watching the emotion play out. And it made me think of, as you know, Howard, like I love to learn from history and everything. And there's a great book everybody should read, Charles Kindleberger's Manias, Panics, and Crashes. And there's a chapter in that's called The Emergence of Swindles.
Ooh.
And yeah, and that's
how old is that book?
I think it came out in the 60s or 70s, perhaps.
What a great word, and so true.
Yeah. So basically, the emergence of Swindles chapter is about 3/4 or 80% through the bear market, and his point was that the swindles have been going on all along, mm-hmm. but in a bull market, nobody cares. When people start having losses, they want their money back, and because parts of what happened were frauds, when people want their money back, that's the catalyst for the revelation of the fraud.
Yeah. If I play some inside baseball for you here because I know how the pipes work. Very good point. The second derivative of this is LP's not going to make capital calls to all of these funds or even smell. I don't think even the fund managers realize the pain that's coming in this crypto space, because I would say 50% of LPs were already hurting, and now they'll just say, listen, sue me, and I don't trust this industry. The whole thing's a fraud. It happened in 2008 in Goldman real estate funds, to be honest, so to think it won't happen in crypto. So these are the second order effects. What is amazing, and I know this is terrible, is how lucky we are that this didn't go on for another year, because his evil, devious thing was that he understood pipes and the trading enough, being trained at Jane Street. So he was, trained in the sausage factory. He had just bought a company called Embed. He had built APIs so that, in an unregulated, they became the king of whatever crypto, regulated, unregulated was. They had attached their pipes to people like StockTwits and Alpaca and hundreds of other firms that were connecting their customers to FTX. So he had come up with an evil genius way to drain people's accounts based on what he was doing in a small way, $10 billion way. This could have been $50 billion, let alone another year.
Well, one of the things you see, Howard, this kind of gets back to a couple of points that we made in our prior two discussions, which is really the importance of valuation, which is kind of the silent killer in bear markets, and it's the power behind the throne in a bull market, right? Because there's two parts of valuing securities or at least equities, right? One part is whatever the fundamentals are doing, and the other part is what you pay for those fundamentals. And when we talked in 2020 and 2021 and so forth, I mean, the concern that I had was that people were clearly on a historic basis overpaying wildly for many things, and that's really that's an exercise of kind of mass belief or suspension of disbelief. And when that flips, what you can often see is people start to distrust everything, and that's how you get really cheap prices, which are good news for value guys like me and people that practice that valuation discipline, in my opinion.
Yeah, it is amazing that it got to the point where even Zuckerberg caved to the pressure and fired 13,000 people. So the markets will make you, even the most arrogant, flinch, as they've done this week with both Facebook and now Sam on the run. And so going back to Madoff, it was amazing because Twitter, I was super into Twitter at the time. And I don't know if people remember this, but CNBC had a camera outside his house, and we were tweeting about it, and I had an @Bernie Madoff account, acting as if people on StockTwits could there was an account parodying Bernie Madoff on the run. That couldn't happen today per se, but it actually today Sam is tweeting as himself from the Twitter account. So it's as if Bernie Madoff, if he had had Twitter in his house, what would he have been tweeting out? But we watch this unfold on TV. Now it's unfolding globally 24/7, 365 with a massive audience. And, the book the Swindle book you mentioned, I mean, the scale of which that stuff can be done today is staggering.
Well, I can tell you I'm looking very much forward, if Twitter is to be believed in this, that Michael Lewis, if I saw on Twitter, had been basically embedded with Mr. Friedman for last 6 months or so. So if that's true, then I'm going to pre-order that book because it's going to be interesting.
But it's also a little bit creepy because a smart guy like Michael Lewis, when would he have caught on? And what responsibility did he have if he was planted there? I'm not anything against, listen, I'm just saying that is a little weird now. If we know he's been there 6 months, there's no way a guy like Michael Lewis could be fooled when a guy like Matt Levine had him on a podcast and kind of tripped him up in 10 minutes.
Well, I don't know, Howard. I mean, I think, when I sit back, and this is kind of getting back on the investing topic kind of in general, I mean, so much I think of what we try to do. It's actually really simple because, you're really just trying to avoid doing stupid things, because investing is kind of like a report card, I mean, you can't go into your parents and say, wow, look, I crushed geometry. I got an A, and then maybe you got like a C or a D in, chemistry or something. I mean, your investing kind of GPA is sum total of the good stuff and the bad stuff. And so I think part of kind of risk aware investing is just to say, what are the things you want to avoid the mistakes in? And and news can be a challenge and sneak up on everybody, right? But that's why we really try to have valuation at the core of how we think about, the world, because, a valuation perspective says, I'm not sure exactly what's going to happen, but if something bad happens and I own something at X price, how do I feel about my potential upside and my potential downside? And so you're not really approaching the world and saying, I know exactly what's going to happen. You're approaching the world and saying, well, if something scary happens, at least I own this, and that won't be so bad.
Yeah, and so people now are going to have a come to Jesus moment that valuations, again, do matter. That won't mean that the next cycle won't happen, the same things won't happen, but here we are. What surprised you so far the most about 2022?
Well, there's a lot going on, but frankly, Howard, this is on wearing my macro hat. It's that rates are up quite a bit, and parts of the economy seem to be taking that higher rate in much more robust fashion than I would have anticipated 6 months or a year ago.
Correct,
in my opinion.
Like if you had told me rates would be 5% at the beginning of the year, my portfolio would not look the same as it does today. And so you're right. Like, we are surviving this thing pretty well relatively. Is that what you were saying?
Um, well, I guess maybe partly, Howard. I mean, I saw a statistic that really kind of blew me away, and I think it was that there's only been 5 or 6 years in the past 300 years on this. It's like a GDP weighted index of bond returns where returns have been this bad. So it's really a rare set of circumstances. So I know the equity market's been mauled pretty good, but frankly, the bigger damage, the more surprising damage, the more historically anomalous damage has been in the bond market.
Yeah, what a year. And so how do you talk to clients today, November 2022? Like what, because you guys have always focused on fundamentals and valuations. So what is the mood like that you're feeling?
Well, Howard, I mean, I was a value guy kind of on the outside looking in while we had this, real historic bull market in growth. That started for very fundamental reasons, the iPhone cycle and so forth. And ultimately, I think in retrospect, we can see that it got a little silly, which is what all these cycles do. Mm-hmm. So if we're going to be valuation driven, we're probably going to check out early, and I think we did. And so for like the last 6 months of the bull market, you end up, kind of like the grumpy neighbor that's yelling at the kids to stay off his lawn, because you're just saying, this doesn't make sense to me, and you kids are going to hurt yourselves, and so that's not a very positive message. But frankly, our message is getting a lot more positive as valuations are coming down, because again, Howard, I certainly don't have a crystal ball in the future, although we do have views I think we can defend, but I would much rather begin any kind of uncertain journey with a price that's meaningfully marked down, and so it's de-risked.
Love that.
So that's where we find ourselves. And so frankly, I mean, I'm kind of having fun again going to work, and it's been a while since I could say that.
I can say it's been 2 years since it's been fun going to work, meaning I've made mistakes. I've killed my time with podcasts, with speculating in crypto, with, burning some of my own capital. But the power of having LP money has forced me to at least sidestep and not have fun at my day job, right? I had to make up a day job for a couple of years because in my world, prices were so far away. It's easy for me to buy Zoom because I can sell it the next day, but it's not easy for me to invest in an overvalued startup that I got to hold on to for 10 years. So really my job helped me stay out of the market, which forced me to do some stupid things with my personal money. But that's easy for me to fix because you take the losses, you move on. The exciting thing for me is that I get to talk to you and understand your point of views going into this. But what excites me is the same as you is I can now talk to founders about the valuations we were at 2016, 2017, because I'm not the old cranky guy. I'm somewhat the reasonable guy. And so you're seeing that as well as what you're saying in the public markets.
Yeah, I think so. Because remember, Howard, the way our wealth management business works is people, roll into our office, often from other advisors and so forth, and they're saying, I'm retired or about to retire. The markets are terrifying, but like, this is the situation I'm in. I've got to make this money work. Can you please help me? And it's very humbling, and it's very scary. It's a big responsibility. And so when I face the future with more confidence, it's because I'm seeing areas that are down materially in price. And so I feel like no matter what happens from here, I've got much better valuations to begin with. And so the future will be the future, but my choices are broadening. Like the smart things I think I can do, I'm seeing more and more opportunities where a year ago it was really challenging.
So let's walk through deglobalization. I want to just throw it out there and lean back and let you top-down riff through how you see the world under that one word, because, that's what you said you're panicked about, even though you're not panicked about it. What does that word mean to you? You globbed onto that early. So go ahead and tell us what that means to you.
Yeah, well, sure. I guess I'd recap briefly 2 points, Howard. One, of course, is, my theory of bull markets is that the people who are going to be the leaders of the next bull market are going to be the ones who can successfully categorize it in a simple way or in early formation of it. Mm-hmm. Number one. And number two, it's my opinion that the name of this cycle going forward will kind of be a a deglobalization cycle, and frankly that's a reversal of trends that have been in existence since the end of World War II. So this really is a reversal of very high magnitude if our view is correct on it. And so what that means to me is that the market volatility makes sense, because what you're seeing is a falling off of the old leaders who were wildly successful because they met the narrow and unique set of circumstances that allowed them to just blossom into the world-beating stock performers that they were. And if that world is over and dead, and there's a new world that's rising, then they are not optimized for the world that we exist in. So my view is that they should bleed out, and that loss in market cap will go to the new leaders. And the new leaders are still rising, kind of yet to be identified, or certainly yet to be capitalized by the market as much as, say, the failing leaders. And that's where you get a bear market. It's just a change in leadership. And so if you look at that as a natural cyclical change, it makes it a little easier to deal with, in my opinion.
And so what does what does it start looking like? We've had the first phase of the war. What set this off?
Well, let's see. Well, of course, a big part definitely, again, if you take a step back, I think, Howard, if you look back over history, the periods of time that have been dominated by open markets, lack of war, peaceful coexistence, and a growth in commerce are when there is kind of an undisputed, in politics they call this like a hegemonic power, or someone who's so well established that nobody dares to threaten them. And so this goes all the way actually back to kind of the Mongol Empire when they conquered the Chinese, like in 1100 or something like that. If you go back, you look at that, there are these, periods, like you may have heard that term like Pax, Romana, right? Or Pax Britannica. These were periods when, the Roman Empire was ascendant, and they built all the roads, and Roman laws were laws. And as long as the world is fixed like that, then, the normal rules can rise to the top, right? Which is that people just want to get along. They want a better world for the kids. They want to make some money. They want to hang out with their families. And that's kind of a genteel, happy world. It's one where people can make money, and in retrospect, it's a favorable time. But, so when I think about deglobalization, what that means is basically like Putin's invasion of Russia was really only the latest of these deglobalization like shocks. But basically, to me, that's a representation that the Russians are no longer happy with their deal, and they're ready to roll the dice to see if they can get a better deal. And I think the Chinese seem to be supporting that. So we're, in my opinion, we're going from this stable, known world where all the pieces were in place, and it was this globalized world where trade was expanding as a percent of total GDP, world GDP, and that was driving a lot of global prosperity, and that's been kind of going in reverse since 2015, and this is we're 7 years into it now, and now it's kind of obviously broken. Of course, COVID was a big deglobalization shock. So I think what that means, Howard, is so number one, you've got this big change, and then number two, I think you just look at typical capital cycles. As you know, I've got a long history of kind of investing in cyclical things, and so to me, kind of everything is cyclical. And if you have that framework, then you look for changes, and so. The area that has clearly had a lot of money thrown at it has been tech and cryptocurrencies. It worked for a long time, and now it's really not working. The area in the economy that I can identify that has not been receiving money has been energy, materials, old economy, supply chain, the defense
industrial
sector. Yeah. Well, very much. I think we mentioned in passing last time we were talking. Think about the energy sector. So 2 years ago, crude price was negative. And now you've got this pretty widespread consensus, at least among certain circles, that crude oil is bad. People that that are involved in the crude oil chain are bad. They're trying to get loans banned to these areas and so forth, right? And so you want to talk about capital starvation? Wow, that's pretty impressive. So just from the framework of capital starvation, right? Because overinvestment is what drives long-term returns down, and underinvestment is what leads to higher returns, right? Because in the end, if industries are providing essential goods and services, they need to be able to survive. They need to be able to replace their assets as they wear out. So if you look at the capital cycle that's unfolded, in particular in energy, It's been an amazing crash, some for economic purposes and some for societal purposes. And in my opinion, that's setting up, a wonderful environment for not only higher prices, but higher spending on creating new supply. I think one of the points we raised last time, Howard, right, is that, the Fed raising interest rates is not going to call forth new supply. New supply is needed.
Correct.
New supply is the long-term solution. And whether that takes 6 months or 2 years, we're trying to identify those things that we think are inevitable. And in my opinion, one thing that is inevitable is that if we're going to have the kind of growth we've had in the past, we need more investment in creating real things. And that's not been where the money has gone for the last 10 or 15 years.
Yes. We talked about that last time. The one thing the Fed can't do by raising rates is create more supply. But in the end, can they in the end? Because eventually people get fired and eventually people have to retrain. But I mean, long term, I guess they can. But it was the thing that was irking you before, which is it's the string they can't really pull.
Well, yeah. And it's hard to blame, the management teams, for instance, too much for this, Howard. As you know, I've been around a while, and I remember the last commodity down cycle as it was kind of ending in 2003. And I think there's kind of this typical psychological cycle that takes place, which is basically that, you get the gunslingers who are, go growth at the peak of the cycle because aggression has been rewarded historically. And so those people never saw an asset that they didn't like. They never saw a debt that they didn't like. So they tend to blow money on bad things at the wrong time. And then, of course, the cycle goes pear-shaped. That CEO gets fired, and they bring in the bean counters. And the bean counters clean everything up and sell assets off. And they put their hand on the heart, and they say, we'll never do such horrible things with shareholder money again. Well, we know we did wrong, and we're going to straighten up and fly right. And we're kind of at that phase right now. If you think about the energy sector and other sectors as well, you've got, people returning free cash flow to shareholders. There's a rise in dividends. There's stock buybacks. And so what these people are trying to do is attract shareholders back after just burning them, just like lighting their money on fire in a very painful way. And so we're just in the bean counter phase, Howard. Like, what's going to happen is at some point the Cowboys were going to get hired again because the people who are aggressive at this point are probably going to make a lot of money in terms of the management teams. And then they're gonna fire the bean counters, going to bring in the Cowboys, and they're going to overexpand and blow their heads off, and then we'll start all over again. But that's probably 5-8 years, who knows? But I think it's got legs.
Yeah, that's a great riff, and that's what I'm here for. So, and you've talked about this on the last podcast. I just wanted to bring you back on to just level set here. So, for context, go back, because we've been talking about this now for a year and a half with you. We kind of only a year in, because it was still raging while we started having this discussion. And now we're like, and even me, like, I knew the trend was over, but I still own some tech stocks. Not, very high cash and T-bill, but I still haven't learned what I'm supposed to do next, right? I hear deglobalization. I understand higher interest rates. I know crypto is dangerous. I know tech is behind. They're slow to have reacted to getting their cash flow or focusing on what Wall Street really has been telling them. And I'll tell you what, I had a conversation with like a major CEO who's a friend of mine of a public software company, and I said, dude, I think, and this is when their stock is down another 50% since then, and it's a multi-billion-dollar company. I said, dude, I think you got let some people go. And the CEO told me, fuck Wall Street. And this is a really smart person.
Yeah.
And when I hear stuff like that, I'm like, we had 10 years of these young guys who had only seen a bull market, even if they had created billion-dollar companies.
That's right.
You can't say fuck Wall Street. You can say fuck that guy, but Wall Street kind of votes. And, those are dangerous attitudes. You sometimes have to listen. You have to learn how to listen and listen properly. You can't listen to everybody. Mm-hmm. But Wall Street was telling people to get their finances in order for a while. Mm. And even Zuckerberg wasn't listening until very recently. So in the world where we're getting religion, what is it? The same stuff, materials, energy, financials, that the value sectors that people need to start learning and understanding?
Yeah, I think if you want to characterize it, broadly, Howard, I think a lot of people would consider the value sectors, materials, financials, industrials, energy, maybe a few others, and of course the growth sectors, were the prior leadership, right? Consumer discretionary and especially tech, the big search engine names, those kind of guys. But and frankly, that's kind of what you're seeing, right? Is you're seeing the led by energy, but you're seeing the broadening strength out there, and so that kind of makes sense to me. And another thing too, Howard, just think about it mathematically. We talked about this kind of big surge in interest rates. It's one of the key differences in, let's say, a value stock and a growth stock or whatever, is a lot of these growth stocks that have been pounded so much, you could call them kind of long duration assets, right? Because the idea was that they were going to blitz scale and achieve profitability sometime in the far future, and then they would be monopolies or whatever. But because it was a high, say, PE company, if there was an earnings at all, a small change in interest rates is going to have an enormous impact on, say, the discounted cash flow analysis of what the same cash flows are actually worth. Now I'm looking at, I got steel stocks that have P's at 2,
right?
So the market is clearly skeptical of the sustainability of that. But with a P of 2, that's 50% essential return, right, per year in terms of the earnings you get for owning that security. So that a security like that is clearly going to be far less sensitive to higher rates, and that's probably a big part of what's taking place, right? It's just duration driven change. But if my expectation for a multi-year bull market in commodities is appropriate, then we'll start to see the earnings come through. And you're starting to see this in areas like energy, for instance.
Yeah. Well, I love the way you put that. And the other thing about, that blitz scaling thing, really smart people saying cute things. Blitz scaling, I don't know if it ever really worked. It definitely worked if you timed around the iPhone and Facebook marketing. But those things, high interest rates and the shutting down of Facebook by Apple, have taken away the trick of blitz scaling, plus what it costs to hire an engineer and then maintain an engineer and keep an engineer somewhat happy. This tech can't work in a 5% interest rate world, especially in one that's deglobalizing, where your product's not going to even be used in China or Russia or half the world anymore.
Well, and the other thing too, I remember one of the things that we talked about is, my experience is there's been at least 2 big leadership changes. There was the tech in the late 90s, which crashed. It fell 85%, and then commodities led for 8 to 10 years, and then they crashed 85%, and then tech led for 10 or 15 years, and now tech is crashing. So I don't know, why won't that fall 85%? That's been my experience the last couple of cycles, and that's why I think the trickiest thing in this whole business is these leadership changes, because they're very infrequent, and if you hop off a leadership too early, because that's really the world-beating sectors, then you leave money on the table, and frankly, if you overstay, you're welcome. The pain, as people can see in some of these mega cap tech stocks, is just
unbelievable. And I've witnessed it a couple ways, luckily, with reduced positions. But I guess the thing that makes it a little bit different this time is indexing and market cap, because a lot of stocks are down 80 to 90%, but the NASDAQ index only down 30%. So what really makes this difficult is the underlying NASDAQ is much worse than it seems, which is confusing to a guy like me, because I'm seeing already 80, 90% carnage. So it's hard for me to understand what's next.
Well, I'm just trying to focus, Howard, on this leadership, framework, right? Because remember that owning leadership for the course of a cycle can be a life-changing endeavor for people to do it appropriately. And
correct.
So that's rare and powerful, and it's very, very difficult. And so not many people will do that well, and you can focus on and still get it wrong. However, what I'm trying to do is I am a bit like Cortez and, burn the ships. Like I'm really not looking at the old cycle stuff anymore. In our kind of more concentrated strategies in particular. I'm just really focused on what is what is that next set of leadership in it? And I'm trying to drive that through that deglobalization framework and say, as well as these capital cycle framework, and say, okay, well, what are the things that I can buy where even if I'm wrong, I shouldn't, lose any money, or certainly shouldn't lose much money if I've done my work appropriately. And can I build a smart portfolio like that creates, optionality? That was something I remember being very valuable, Howard, in the last commodity cycle in which I participated. Was, you start off with the thesis that, something was underinvested in, it needed higher prices, it would be a good thing to own the equity ahead of that. And then, and what I found is your thesis would be validated by the market. And then there may be 2 or 3 or 4 aspects that you literally never anticipated. And they come through, and that's how you make like an awful lot of money in these things. And frankly, when you begin that journey, like you don't know those things are going to happen. Just like I don't know. I mean, how many people could have appropriately anticipated in 2007 how much money Apple would make them? I mean, it was incredible what happened, and so they kind of went from strength to strength. This is why it's so challenging, to find those leaders, because it's really a small subset of what's going on in the world. And so I can tell you one of the things that I think about in our internal discussions clearly is, we're very cautious about, let's say, the market, but we're excited about, the opportunities that we're seeing, because, we're trying to have a focused enough, view on investments where we're not really that worried about what takes place in, the market. We're focused on those new leaders. And that's why, it's exciting, because frankly, for the last year or so, I was just a little bit like a boxer, and I was trying to take my punches well. I had my hands up trying to protect my face, protect my body. And, and we were very defensive. And frankly, we're dialing up the risk in the areas that we think could be the new leaders. And so that's why I'm having fun again.
So for someone who's not high net worth yet, but wants to focus on this, let's say there's a 6 to 10 year cycle that takes place. There are a few ETFs that allow people to at least participate in what this value/material cycle looks like. Are there 2 that people could watch on their screen to just kind of see this unfold?
Well, I'm sure there are, Howard. I mean, as you know, we tend to invest in the underlying securities in our own investment strategies.
Yes.
But I think the sectors that have been starved of capital are the ones to pay the most attention to, and that's going to be the energy sector, even here, in my opinion. Frankly, oil services should be the biggest recipient of the new cash flows needed to grow supply once people reach the conclusion that that's a smart thing. That's another area, frankly, a lot of the metals tend to do well, because when you have these commodity cycles, Howard, one of the things that you see is, all the commodities tend to participate in one way or another. So frankly, agriculture is an area that we think should participate, as well. Those are some of your, big 3 or big 4. And then perhaps finally, there are a number of companies that specialize in, creating new capacity in these sectors, kind of like oil services for things like their companies, for instance, that they make new chemical factories, or they help people build new mines. But it's a very different set. It's a very different set of securities, but the dynamics are always the same, Howard. Really, it starts off due to a capital starvation cycle with conservative management and street that can't embrace the scope of the change yet. And then what happens is, in your typical cycle, right, is a series of fortunate events will take place that will surprise people. And then as it starts to blossom, people get crazier and crazier and do stupider things. So frankly, I was having this conversation with our director of research, Siv Abraham, and we were both very confident that probably 2 years before the end of this thing, we'll bail out on it early, And so
that's unfortunately the way it goes. You leave a party while it's in full gear is the hardest part, but it's the most important part. So that's very helpful, those sectors, so people can do the work there. What about interest rates? Does anything scare you there about what the Fed's doing or the results so far?
Well, that has been a surprise, Howard, because I frankly did not anticipate that they would be raising rates this quickly, and it would do so little damage, ostensibly, at least to the real economy. It's done damage to, say, tech, for instance. But again, Howard, I think one of the things that I've come to believe is that once a cycle, the long mechanism of it those gears begin to grind, you start to change, that, the fundamentals will arise to support it. So perhaps could that mean high nominal rates but low real rates on an inflation-adjusted basis? That's one outcome. Or weaker dollar, perhaps. Could that be a means to facilitate this? But remember, Howard, the imperative that we believe in is that if you have had this underinvestment cycle, what's important for the market, because the market does reward people that provide solutions, right, is like crude oil. Like if we are going to consume crude oil, then companies are going to have to make enough money to replace that production growth, which means they're going to have to be, drilling more, which is good for, the oil service companies and people that make, oil tubes and this kind of stuff, right? So like that set of fundamentals, it's our expectation, like it's just going to rise. There's only so much you can anticipate at this point. And I guess my framework has been that the fundamentals will kind of find a way to take the cycle that's underway and validate it and supercharge it.
Beautiful. And with respect to the recent hurricanes, how was Naples affected? How did you guys dodge that bullet?
Well, yeah. Thanks for asking. I tell you, it was a huge blow for for Naples. It was pretty much almost a direct hit. It was I guess a Category 4 or almost 5 for a little bit there. So there's a very damaging storm surge. A lot of people lost their homes, and particularly even a little bit north of us. So it was really damaging. But I can tell you, I've really been impressed with how quickly the authorities have organized themselves, how quickly things are cleaning up, how fast things are coming back. So it was a terrible blow, but there was an amazing response as well.
The beach where I stayed, like the hotel that I stayed, were they affected?
Yeah, they probably had 10 feet of water through through your hotel.
I remember, I love that place. I sit right on the beach in my room. Yeah. So you're saying that room was probably underwater.
Yeah, and of course that's a real meaningful blow for real people here, because the tourism business is very important, and there are a lot of people who don't have jobs anymore because it's going to take a year, 6 months, however long, to get those things open. But so it's part of the struggle of living down here, in Naples. I mean, but it's got wonderful people and they're working hard, and I had this conversation. A lot of friends were kind enough to call and ask, and that was the two things I told them. It was a terrible blow, and it's going to come back fast. Because that's been my experience. Is it's a well-run area and people take rebuilding seriously, so it's going to happen.
Yeah, I love Florida. I love Naples. I love rediscovering it with you and fishing. So I really appreciate your time. I mean, listen, it's for me, you've been a steady Eddie. You haven't been like pounding the table. People are dumb for doing this. You've just been kind of being that steady hand, explaining to people how cycles work. And, it is always a pleasure to hear how you think about things. And I appreciate your time, my man. Say hi to the team, and hopefully I'll see you out in Naples soon.
No, look, I appreciate being here and the opportunity to chat with you, Howard.
Thanks, Lewis.
Bye, guys.
All right, buddy. See you.
Thank you. Bye.
K-Nut!
Hey!
Yeah, that was Lewis Johnson, who is highly excitable but was very calm here. He and I have been friends fishing and talking about markets for a long time, and I knew his day would come, so I started picking his brain here, 2 years ago. I just started feeling weird. I wish I understood more. I wish I had listened more, but it's hard when you don't understand. I remember when oil went negative, I was like, you have to buy oil, but I didn't hold it, and now we're at $90, and what he's saying is this cycle is early because it's underinvested and under-serviced.
Yeah.
So we'll check back in 3-6 months with Lewis, see where his head's at in this cycle, but you are listening to Panic with Friends. Canute and I sit down with people like Lewis, traders, investors, money managers, entrepreneurs, some of them bad. As we found out recently with FTX, and try and get people a little bit ahead of the market. It's quite humbling sometimes when we're wrong. You can go to Spotify, Apple, Google, search my name, click subscribe, and you will get a podcast from Canute and I every week. Thanks, Knut. We'll see everybody next week.
Howard Lindzen is the founder and general partner at Social Leverage. All opinions expressed by Howard and podcast guests are solely their own opinions and do not reflect the opinion of Social Leverage or StockTwits. This podcast is for informational purposes only and should not be relied upon for decisions. Guests may maintain positions in securities discussed in this podcast.